Well, Jacqueline, thank you so much for coming back on the pod. We do a lot of business back and forth talking about risk management, and I wanted to bring this back and freshen it up a bunch because it really is the foundation of a financial plan in talking about insurance and making sure all of your basic risks are canceled off. But then getting into estate planning, it becomes an even bigger conversation. And we kind of bookend the financial plan, like early life has all of this insurance planning to make sure that catastrophic things don't happen. And at end of life, we want to make sure that we're not giving away our estate to taxes. And so I wanted to talk about all of that in our conversation, but give you a moment to kind of reintroduce yourself as a member of our team and talk about what you do and how our clients work with you.
Well, thanks for having me back. So my role with your team is really to work particularly on the insurance side, but it's always a financial planning thought first, which is always why it's valuable to work with you and advisors like you. There's an opportunity to talk to clients at any stage of where they are at in life, and that's regardless of age or financial position, to just make sure everything as it should be. And then just naturally, more often, it's not. So on the earlier stage, being able to talk about risk management, and then, as you said, as things move along, talking to them about what's the legacy, what's the wealth plan, how are things going to move through your estate. So there's a whole bunch of different products out there to help support it, but really it's just engaging with your clients to understand their financial position and see from a protection standpoint or a tax standpoint, are there any insurance tools that would benefit the situation that they're currently in?
Yeah, insurance really is something that can make or break a financial plan, but most people would prefer to skip it. Maybe let's talk about why people avoid talking about insurance and what do you hear as some of the big objections in your career that you've seen?
I think first and foremost, I'm not going to pretend that paying insurance premiums is a fun thing. I don't think anyone gets their car insurance or home insurance bill and they're like, yes, this is my favorite time of the year. So it is another expense, particularly when we're talking about risk insurance. From a not doing it standpoint, so often, and I was just in a room full of business owners and we had a really good conversation. And the one thing that they all kind of said in various forms was, we don't know the questions to ask or who to ask them of, and no one's prompting us to have these conversations. So for so many, you get to adulthood and there's been no playbook on the financial side. I know all of us in our industry go, more needs to be done in high school. They get through university, you get a job, and all you're really told is, well, save your money, put it into an account, and don't spend more than you make. And that's good, but it's not great. There's so much more to it. So I think just a lack of awareness is probably driver number one for why people don't have it. And then there is still a lot of concern, and more it's an emotional decision. Especially in some cultures, it's really frowned upon to talk about death. It's almost like you're welcoming negative thoughts to that individual. So there's an initial kind of panic that sets in, which is why so many people don't have a will. They just don't want to think about it. It's easier to put it off to tomorrow.
Yeah,
And
out of
because it's
sight, out of mind, right?
exactly. So your car insurance, you have to do that. Your home insurance, your bank says you have to do that. No one's coming at you to say you have to do an insurance review.
That's a really good point. People don't need to do this, but they really should do it.
Mhm.
Have you ever seen the memes about the first guy that thought up insurance? They're just spectacular. I should send you some of these things because the idea that you're going to pay a company some money so
Mhm.
that if something happens, they'll pay you money back is
Mhm.
like at the most rudimentary level is really insane. But we've seen this work out extremely well for so many clients that are planning for things to happen. And that's why we get into this conversation, right?
Yeah.
It's not about frightening people with the cost of it. It's really like if you don't do this, the cost is much greater in most cases. You and I have talked about this at nauseum, but I bring it up to clients where everybody has seen someone important to them have a GoFundMe page because something has happened that they didn't plan for effectively, and now they're in a really tight financial space. And so I wanted to spend a bit of time talking about that particular type of insurance. It's critical
Mhm.
illness insurance, right? And the different scenarios that we get into, and maybe give us some examples that you've seen of different ages of folks
Sure.
that this is really applicable for.
So, what we're talking about is critical illness insurance, and this one hits close to me. I've told people in various meetings when I look at my grandparent level, there's a series of heart attacks, cancers, and various things where had they all had it, they all would have paid out on claims. And that was part of the driver when I got licensed now 15 years ago for myself to get a critical illness policy. So now, having been doing this for a while, uh, part of the scenario that we see, unfortunately, is I'm at the age set where those GoFundMe pages are popping up more frequently. And there's been people from high school or spouses of people from high school where, unfortunately, there's the kidney disease or the cancer. And we're not talking about people in their 70s, we're talking about people in their late 30s, early 40s. And that's terrifying because, one, you got someone ill, but typically they also have a mortgage, they often have young children. And now, rather than just focusing on getting better, they're having to strategize and really beg for help to just take care of their financial situation. Couldn't you alleviate some of that pressure? And you can with critical illness insurance. And so, on the other side of that, when I first got licensed, I had some friends and family willing to let me just practice on them. And so, I had a friend who was actually my maid of honor. Her and her now husband purchased critical illness insurance. They didn't have the big mortgage yet. They didn't have the kids yet, but they knew it was coming. And so now, 2 years ago, she's in her mid 30s. She was diagnosed with cancer. She didn't have the GoFundMe page because she had enough critical illness come in that extra expenses that come as a result of having a critical illness has been very well covered by the critical illness policy that she had in place. She's got no concern from a financial perspective. It's all about, how do I get better? How do I keep making memories with my kids? So in that kind of scenario, that's what I would want. If I'm going to be seriously sick, I've got kids, I want to make sure I'm putting all my energy into the right direction and not how do I make my mortgage payment. And that's where that type of insurance is coming in.
Yeah. I talk about that a lot too, especially with people, busy professionals with kids. It's so cheap to put some of this coverage on the kids. It's obviously, like you say, it's not for the kids. It's for you to be able to take the time away from the office or whatever to feel comfortable. I love telling the story about how critical illness insurance was actually invented. You know, it was this surgeon in South Africa, right? And he discovered that rich people recovered from surgery and illness faster than people that didn't have means. And he couldn't figure it out. And it was all came down to, if you don't have financial stress lingering in the background, you're able to focus and your body's able to focus on recovery. And boom, it was born, right? And every insurance company on the planet has tried to figure out a way to get this into their local markets. It can be a life-changing thing for a pretty small amount of money. But, you know, you and I have talked about this in the past with clients. You either are going to pay a small insurance premiums, or you're out there begging for help from friends, family, or just the internet. And that can be a stressful thing to have in the background because, you know, regardless of sometimes the culture, but it might just be a societal thing. People will feel that embarrassment or shame, and that does not help in the recovery process of something serious. What are some of the biggest illnesses that people end up making claims on in these policies?
The most common are related to life-threatening cancer, heart attack, and stroke. And I realize that there are some people, I'll say they have the good heart attack. They have a heart attack, they go to the hospital, they come home, 2 weeks later, they're back to work. Now they just have to make some lifestyle decisions. So, yes, the critical illness policy would pay out in those scenarios, but that's not what I'm talking about when a critical illness is going to kind of rock your world. I'm talking about the ones where it's ALS diagnosis. That's a big one because you don't recover from ALS. That's a progressively worse scenario, and life-threatening cancer. Those are the two. Kidney disease, organ transplants, all that kind of stuff is covered as well. But the ALS and the life-threatening cancer are two really big ones. Stroke would be the third, where that can basically just turn your life upside down in an instant and quickly. And so once you have those diagnoses, typically there's going to be some adjustment to your life as you know it. There's often additional medication costs that come in because out here in BC, and I think for the rest of Canada, you pay for your prescriptions if they're not administered at the hospital. When it comes to ALS, you're very likely going to need some things to come into the home. Eventually, you're going to need a certain type of bed to lift you up, a hook from your ceiling to be able to bend, adjustments to your shower, home renovations and a ramp are going to come into play, vans, all that kind of stuff. And all of it costs money. And so when we're considering it, I hear from some clients, oh, if I just save that money, I'd have it. And that's an
Right.
assumption of time that your critical illness scenario is going to happen when you're 65 or 70 and you've done all the accumulation. And what I'm seeing, unfortunately, is there are a lot of people in their 30s and 40s who haven't accumulated because they've been in the figure out a career, down payment on a home, manage the mortgage, have a couple kids, which we all know are super expensive. And then it hits and you're like, you're in the worst financial position you're going to be in life at that point in time. So you're not drawing from any savings. Unfortunately, you're in a I need help mode. That's where that critical illness policy, and they pay out tax free. So you buy your amount, you make a claim, it's dollars in your pocket, and you determine where they go. They're not prescribed that it has to go to medication or something like that. It's
Mhm.
whatever flexibility you need from those dollars.
I find that there's a lot of confusion amongst the general population between what critical illness is, how it pays out, and why, and then what disability insurance is. Maybe just that people think that they're the same thing. Can you articulate a little bit of the differences between those two?
So they complement each other really well. Disability insurance, if you're employed, you likely have some form of it through your group employment plan. So disability insurance is usually a percentage amount up to a limit of what you're currently earning. So if you earn $10,000 a month, your disability plan might cover you for $6,500 a month. That's a tax-free monthly benefit, normally payable to you after you are fully disabled and off work for 3 months. So you've got to have enough savings to cover the first 3 months, and then you get this monthly benefit. Typically, it pays tax-free, but check your group plans. And that will go on until you are able to return to work, or if there's a limit on the plan. So a lot of plans have limits for how long they'll pay out. Critical illness, on the other hand, isn't if you are capable and physically able to go to work. And if a doctor says, no, you can't go to work, it's do you have the diagnosis or not? Often within 30 days, here's your tax-free payment, do with the funds as you need. So it's faster in terms of a deposit, and the barrier to entry is a little bit different because you could still physically be capable of working at that time.
Right. And you brought up a really good point of many people will have these group plans through work and they think, oh, I've got all the insurance I need, but they don't really own that plan, right? Like they can't take it with them. How do you approach that conversation with folks as far as augmenting what they've got at work?
So a lot of the plans do have limits, especially for higher income earners, where we have to do what's called a top up. So we use the employment amount as a consideration, but we add additional policy that the person owns themselves. It is also a question of what's the direction of your career? Do you think you're going to be doing this for a long time? A lot of the people we work with are a bit of an entrepreneurial spirit, so it's kind of a launching pad. Within the next couple of years, they're thinking they might go out on their own and do consulting or something. Preemptively putting insurance in place before they do that is important, because once you're a new business owner, you have no income history, so you don't want to go 2 years with no coverage. And then the other factor is employers are not required to provide you that coverage. So when I talk to employers about group insurance, we start with a certain amount of coverage that's affordable, but those rates go up over time. So at some point in time, they could very well adjust, augment, and reduce any coverage you had.
That makes sense. I mean, I've experienced this right here at Raymond James, right, where there's a maximum that we can have as part of our group plan. I personally hold external coverage with a different company than my group plan is with, just to kind of diversify it out. I think a lot of corporate employees have tuned into this, but you brought up business owners, and that's where I'd love to take our conversation now, is into how we start planning with business owners and maybe some of the biggest mistakes that you see in how they handle risk and succession planning, because those are big topics in the news these days.
So yes, I work with a lot of business owners. To me, they're the most fun because there's so much to consider. So my planning brain gets a bit of a workout there.
Yeah, the more complicated, the more interesting it is,
Yeah,
right?
that's the fun part. I'd say a lot of them do operate with a bit of an ignorance is bliss thing. Part of it, I think, is business owners they're a unique breed because the successful ones are so focused and knowledgeable on their business and what they do, and so they heavily rely on advisors to figure out the money part of it. They're very reliant on their accountant. They're very reliant on advisors like yourself, and so they need others to tell them financial strategy. And so the risk with that is that a lot of accountants are tax preparers, not tax planners. So they
Mhm.
take in the information, they prepare the tax return, they give it back, and then the work there is done. And the business owner thinks that they're doing the planning for them when they're not. So from there, they usually think their accountant is taking care of it. And then advisors are not all created equal. So you think beyond the investment portfolio, but there is a large swatch of advisors who they do investment management and that's their stuff. And they think everybody else is, excuse me, taking care of
I
it.
saw this over the 10 years that I was an investment wholesaler. I spent so many times in offices with advisors that I thought, these guys are running massive practices, but they didn't even hold an insurance license, and nor did they have an insurance specialist on their team like we do
Hmm.
with you. Now, I'm insurance licensed, and we came from a background of years and years at Sun Life, so I've got a good grounding in all of this and how it works. But there is a huge value to me and my team, where we specialize in investment management and financial planning, to have a specialist like yourself that has done nothing but insurance planning for like the vast majority of your career. So being able to put a specialist in front of somebody is really key to how we work as well. But anyway, not to interrupt you and derail
No, that's
the
good.
conversation.
That's exactly the point though. So when it comes to business owners, like I said earlier, they don't know what they don't know. Well, they really know what they do know, and that's
Hmm.
why they're successful. But when it comes to handling risk and succession, they've been so focused on their business and driving wealth and driving revenue, they've kind of had blinders to everything else. So usually when I'm in that conversation, I'd say a good 75-80% of them, they haven't done really a financial plan. They haven't had an insurance assessment. They might have some term insurance because they bought a house 15 years ago,
Right.
but there's just not a lot done. So that's a fun opportunity to come in and say, okay, like tell us everything about the business, about your life, about your financials, about where you're going, when are you going to sell? Let's engage with your accountant. A lot of them are very warm and receptive to that idea, which is fantastic. Others, you might have to warm up a bit. And then we have a really deep dive into the situation. And insurance is very commonly a part of that because depending on the stage of business they're at, either there's a significant risk. Someone's usually driving the financial cash flow into the home, and if that stops, the family's in trouble. Or, given what we do, a lot of our families are on the other end where they've accumulated significant wealth. They know they're going to have extra, and the question changes to, well, what if I pass away? But when I pass away, how do I get all this wealth out to my family and not have a third or half of it go to CRA? And so that's another aspect of the conversation.
Yeah, you either pay insurance premiums or you pay taxes, but pick your poison, right?
Mm-hmm.
The business owner side of the thing is interesting because, yeah, there's so much planning that can be done. I find so much of the challenge is actually just pinning them down to having the meeting, because they're an expert in whatever they're selling or whatever their business is, but they're often so swamped with work because most business owners I know don't have the time to work on their business. They're mostly just working in their business, right? So that can be a challenge in its own right. But in the same vein of business owners and business partners, can we spend some time talking about buy-sell agreements? Any partnership would probably have heard of what a buy-sell agreement is. Their lawyers probably recommended them to have it, but a lot of them go unfunded, right? And how does insurance work to pay for these contracts?
So you're right. A lot of business owners, when there's two or more people involved, usually when I bring it up, do you have a buy sell agreement? They go, yeah, we have one. They go, tell me about it. Oh, I have no idea, is usually the standard answer. They have it, they know it, it's filed somewhere and forgotten. So when we go through it, usually there's some caveat there to say if one of the shareholders passes away, there's an outline of how they evaluate the business and the funding for that one shareholder to buy the shares of the other, now the deceased shareholder. So the outline for that is there. What's often missing is any contingency for what if someone doesn't pass away, but they're now out of office for a significant period of time. So if they are involved in, for example, if they have a critical illness, how long is the other shareholder going to keep the business afloat, continue to potentially pay salary and profit dividends to the other shareholder? How long are they going to carry them? So
Mm-hmm.
when there's not the information in there, that leaves the company and each individual shareholder up for risk because the one sick needs the money, the one surviving and keeping things afloat, probably at some point, even though your heart's hurting for the person sick, is going to get a little frustrated by doing all the responsibility and now losing half of potential profit away. So in terms of funding, there's a couple mechanisms we look at. One naturally is going to be some form of life insurance. The company usually buys it. They are the beneficiary of the policy. They pay the premiums. And in the event one of the shareholder passes away, the life insurance proceeds come into the business, and now the surviving shareholder has this capital to buy out the shares of the deceased shareholder. The other scenario that we look at is in relationship to long-term disability and critical illness. And corporations can buy those types of policies too, so that if a shareholder has a critical illness diagnosis or is off of work for often we'll look at 2 years to say, okay, after 2 years, if they've not been able to work, the likelihood of them coming back in that same capacity is probably slim.
Hmm.
So how do we give the operating shareholder the capital to now buy out that person's shares? Because life insurance obviously hasn't kicked in. So there
Yeah.
are different mechanisms for funding. We want to make sure the buy-sell agreement has the different parameters set to actually initiate and have the clauses to do that.
Yeah, and often this will be different between the partners and what their role is in the company, right? You might have one key person that is much more crucial to the business operations than another that you want to overload insurance onto, because they might be the best salesperson to ever walk the earth or something, and the other person is like the ops person, right? So having that conversation and like getting into the nitty gritty of how does this company work and what are your roles here, because not every person is exactly equal when it comes to making a business run. But that's very interesting. I think the buy sell agreement conversation is another one that's so valuable to have in these partnerships, because I find that, corporate owned life insurance tends to be really misunderstood, and the classic recoil happens from a business owner because they've absolutely been approached by somebody that is either just new to the business, doesn't understand how to structure these things for a long time, and doesn't understand how to educate people on an ongoing basis to have that buy-in for why they even have this thing in the first place. Not dissimilar to their own buy-sell agreement, right? The lawyer set it up and the guys don't even know how it works. There's a lot of education in this as to keeping them invested in why the plan exists in the first place. And the tax efficiency is usually how I get into but how does that sound from the client standpoint when you're into the conversation around why this is so tax efficient to own the corporate owned life insurance? Can you give some color as to, some of the objections that people tend to have and how you get through this?
So maybe I'll just start with we're talking about corporate tax and concerns in terms of what those are, because that's usually where we have to start the conversation with clients. And that's on a year to year basis. You've got a corporation that hopefully has more profits than the individual needs for lifestyle. So they're accumulating dollars in their corporation. And so in your corporation, you can have an investment account like you manage many of. And because markets and yourself are great, those portfolios have positive growth. So they're having passive income on an annual basis, and the corporations are going to pay tax on the passive income being generated every year. So year to year, as you save more, invest more, have higher rates of return on your portfolio, you're going to have passive income, which generates more passive income tax. So I'll say that's tax consideration number one. And that's the one that we're going to typically be concerned about from day one out to when the person passes away. And then the other consideration is it's not uncommon for us to talk to clients who have multi-million dollars of investment portfolios in their corporation, which is great. But then if we leave it as is and there's no tax planning work done, the person's estate when they pass away is going to have a sizable capital gains tax bill associated with the value of the corporation or the value of the investment account. To get the money out, you have to sell it. So now you're triggering another capital gains in the corporation based on the portfolio. And then now we have this cash in the corporation. We want to get it out, and we have to give a taxable dividend to get the money out of the corporation. So you've got three different tax events happening all on the corporation when someone dies. So when we're having a conversation with the client about insurance and the value of it, we first have to make sure that everyone's on the same page of what's coming. Because it's not an if, it's a when. And that's usually education number one, because no one's walked them through it. We've been so focused on the year to year, we haven't talked about the end. And then introducing insurance is a hard consideration because in your mind, you go, I'm giving my money away, but I've been trying to accumulate it. Why am I giving it away? It doesn't show up in my investment account. I like to see my money in my investment account. So it's explaining that when it comes to permanent insurance, and usually the type of insurance we're looking at has what's called cash value. It's insurance verbiage for the investments in the insurance policy. We're not talking about giving it away as an expense, more that we're talking about it as a reallocation of your investment dollars into now your insurance investment bucket, if you will. And the impact of that is $1 million of investments is going to have significantly more tax related to it than $1 million of insurance proceeds. So when we can outline, yes, the dollars might be similar, but the net result after all those layers of tax and how insurance is taxed is wildly different. That's usually the turning point for kind of the eyes to open and go, okay, now I get it.
Yeah, it's not how much you make, it's how much you keep, right? And
Yeah, exactly.
that is the core tenet of making money. And in Canadian investor standpoint, tax efficiency is the number one way we make money. Number two is actually getting investment returns. So, well, I was just kind of thinking, as you were saying, there's one thing to preserve an investment account, and it's fantastic. You say, oh, I've owned all these shares of all these Canadian companies for all these years. I don't want to sell all these shares. But for a lot of people, that's not as tangible as I meet a lot of people kind of in the age range of like 35 through 55 almost,
Mhm.
where mom and dad or grandma and grandpa have a vacation property, whether it's a lake house or in the case of Victoria, there's a lot of ownership in Palm Springs area
Mhm.
where they're looking at big capital gains of a vacation property that they've been using for a lot of their adult life. And if mom or dad passes away, all of a sudden, who's going to pay the taxes on this place? Will you have to sell it? Like, would you
Mm.
prefer to pay the taxes and come up with the out-of-pocket cash? Or I'm starting to see the kids paying insurance premiums on the parents to have money to pay for the taxes on these vacation properties. How big of an opportunity is this, or how big of a challenge, I guess, is it when we think about the call it the boomer category of folks? There's a lot of secondary homes that are owned by these people and a huge amount of capital gain out there. Do you get into these conversations with the younger generation, and how receptive are they to this?
Of these conversations. So often it is the younger people bringing it up because they're online, they're seeing different things, they're seeing marketing and random TikTok influencers or whatever make a comment.
Yeah.
Now, like caveat there is don't believe most of what you see on social media stuff, but there's a couple nuggets of accuracy in there. So those prompt questions, which is I go, that's a benefit. It's getting people talking. So ideally, my favorite is when families work together over generations. I am very fortunate. Like my grandparents, my parents, myself, like my brother, we're all very open with our financial situation. How do we all work together to do the best we can with what we have? So when it comes to families that have a secondary property, wherever it may be, and they've owned it for a while, and the value has increased significantly, when the second of that partnership passes away, there's going to be a capital gain on the property, whether it is sold or not. So there was just an article a few weeks ago couple had a cabin, and then like 30 or something years later they passed away, and there's hundreds of $1,000s of capital gains. I think it was like $600,000 or something of a capital gain tax bill that now had to be paid. So where does the money come from? Either any of your other investments, because arguably if you have a secondary property, you probably have other wealth somewhere, so there's probably going to be some liquidity. Do you pay it out of pocket? Do you pay the bill? Or is there some pre-planning to say, for the most part, insurance dollars are less costly. So if I'm going to pay a dollar out of pocket, I can maybe get that for 70 cents on the dollar if I did some pre-planning. So do we insure mom and dad, and who pays the bill for the insurance? Sometimes it's the kid, sometimes it's the parents recognize the opportunity and they take care of it themselves. And then from there, it's an opportunity to go, well, what is actually the projected capital gain? How much is the cost of insurance? What's the affordability? And do we tack on a little bit extra? Because for the most part, if we're talking about a holiday home that people actually care to keep in the family, it's usually more than one child as a part of that. And so we're usually talking about closer knit families because they all go to the family home now with the grandkids. And so what you don't want is mom and dad do all this good stuff. They leave the family home to the two or three siblings. Yay, the capital gains was taken care of. That's all fine. But 3 years into owning this thing together, the roof goes, or there's a flood, or someone decides they want to remodel the kitchen. Where's the money coming from, and how are they dealing with that? What were the instructions on how this multi ownership strategy is going to work on this thing? So, having a little bit of an extra to say, we know expenses are coming. Here's a little bit of a top up so that we don't have like this sibling situation where maybe one of them has more wealth than the other. So now they're kind of pitting against each other in this thing that should have been coming from a positive place. So it's opening up those lines of communication is fantastic. The earlier, the better.
Yeah, it's a great point. Canceling off the risk of the place going into disrepair really early is a huge factor that goes unthought about a lot of the time. So for someone listening to this who hasn't reviewed their coverage in maybe years, what is the smartest next step for somebody that is worried about their planning?
I'd say the first thing is to just kind of take note. from the last time they did any insurance review, and maybe it's never, and that's totally reasonable. What's changed? Are you married? Do you have children, a mortgage, a new job? What has adjusted? Maybe there's an inheritance. Maybe you're having to help your parents because of old age. Who knows what? So taking awareness of what's changed. And if nothing comes to mind, you may be fine, right? That may be in the right analysis at the right time and you're still good to go. For most of us, especially if you move ahead 10 years, life doesn't look the same as it did 10 years ago. I know ours don't. So from where we're considering, that gives you an opportunity to say, okay, what do I have in place? And a lot of people like to go into meetings with us armed with some information. So there's a website called insureright.ca. It's by one of the insurance companies. That to me is a kind of initial calculator. You can plug in all your information and you get a general ballpark for life insurance and disability insurance, and I believe critical illness, on where you might want to find yourself in terms of some risk coverage. So from there, you can take what's changed, maybe nothing, what I have, what this projection is telling me, and if it looks pretty much in line, you could say, yeah, I'm good. Or if it's identifying that there are some gaps, that would be the opportunity to obviously reach out to us or whoever your insurance person is to now have that analysis. And even if there doesn't identify any gaps, you still might want to have the conversation, because you may then be finding yourselves in that scenario where it's not a risk conversation, it's a wealth planning, legacy planning conversation. And the calculators are not going to identify that.
Interesting. Yeah. Nice little plug for the Insure Right calculator. That's that's awesome. Kind of expanding on that, if you could give people, if it's even possible to give people a mindset shift about insurance, is there one thing that can change how people think about risk? If so, what would that be?
I would say I'm a parent. So you don't get into your car and drive without a seatbelt. And it's always something you ask your kids, like, does everybody have their seatbelt on? And now we're going to go. Could you drive without it? Sure. We all know better. And so I would say insurance is kind of your financial strategy seatbelt. Can you do without it? Many people can, thankfully. Not everyone's going to have a life altering critical illness in the middle of the career or pass away early with a mortgage and kids. That's the hope, right? Unfortunately, we all know it does happen. So much like we're going to get on the road and the likelihood is we're not having the car accident, we still do the things because it could happen. And that's what I think we need to think about insurance for your financial strategy.
A seatbelt for your financial security. Love that.
Yeah, there we go.
Okay, fantastic. You brought up a couple of times throughout it where the more affluent household is, the more planning they tend to have already done. And this is probably just reiterating the importance of having a financial literacy discussion intergenerationally, right? You know, you and I being in this business, we probably talk to our kids a lot about financial literacy, but a lot of families don't have this conversation, and maybe they don't know how to have it, but there are so many resources now that, you know, even just coming to talk to folks like you and I, but getting into the conversation, making it less taboo, talking about money around the kitchen table and how it works so that kids are prepared is probably more important than ever, because it's getting harder and harder for kids to get a start, you know, coming out of the tutorial phase of life once they get out of high school and into the real world. You know, it feels like there's not as much room for error as there once was. And so you have to have the tools ready to go, and it's less about learning on the fly. So this is a really important conversation for parents to have with their kids. But then, like, grandparents should be backing it up with their kids that are in their probably 40s and 50s, right? Because it constantly changes. You know, you get out of the zone of you need to have insurance, where you have to have the critical illness, have to have the term life insurance in case something happens to pay off the mortgage. When we start transitioning into we don't necessarily need to have it, but we'd like to have it as part of our financial plan. How do you shift that conversation with people?
So it's the financial planning part first. So to me, there's a hierarchy of needs. So we need to make sure income covers lifestyle needs. Groceries need to be paid, mortgage needs to be paid, all that kind of stuff. And then we need to be able to save to some degree, one for emergencies because stuff happens. The roof goes, the water heater, our furnace had to be replaced this week. It happens. And then you've got to figure out, I need to save retirement. And then there we think about what can we do for the kids. That's where RESPs come into play. And then so in all of that, we try to put in some risk insurance. But if we can figure out all of that and go, okay, thankfully you're in a position where that's taken care of. Now we're amassing for long term. And so just by the nature of what we do and who we speak with, those are a lot of our clients. They are on the road to amassing for long term, or they have amassed for a significant amount. So then it's the financial plan gives the outline to show clients, given all these considerations, given what you've told us, given you want to help your kids with a few $100,000 for a down payment on a home, because that's just the conversation right now, you're still going to have a significant amount of liquidity and investments and real estate worth at the end of the day. And that's age 100, because people are living longer and longer. So we're not just planning to age 90 because that's too short. So once we give the security of that, one, there's just a natural relief. Two, there's usually a bit of an aha moment to go, that's more than I thought I would have at that time. Because when you think about the power of the compounding investment growth, and even when we take into account inflation, it makes dollars a lot larger later at time. And so people today aren't necessarily thinking about what that 7% return is going to do in 25 years. That's a lot of growth on different portfolios. So once you've identified what's likely to come or what's the possibility to come, now it invites the discussion of, well, what can we do better? So this is fine. The caveat is most of our clients are fine if they do nothing at that stage of wealth. But now we look at scenarios to say, well, what can we do to make it better? How do we reduce what CRA is going to have? How do we maximize what's going to our kids? And now in more conversations, because of ages of everybody, grandparents are seeing their grandkids and often great grandkids. So now how do I make sure that money doesn't just go to my kids? It wants to go to my grandkids and my great grandkids. What are my options for that? So it's having that financial plan and the awareness to clients is really opening up the opportunity to discuss all these other tools.
Yeah, planning for people that we have yet to meet because they don't exist yet is really
Yes.
important, right? I love being tapped in with the insurance company. It says nobody is more aware of longevity expansion than insurance companies because they have huge financial risk in planning for it. But I often talk in financial planning for retirees, like, you get a healthy couple that's in their mid 60s. There's a pretty high probability that at least one of them is celebrating a 95th birthday.
Yep.
But certainly, the Financial Planning Standards Council would suggest we have to plan to 100. I'm starting to think with how many clients are really healthy in their 90s, like, do we have to plan at like 105, 110? Like, how is longevity changing from the insurance company standpoint?
It's definitely adjusting from like financial plans. When I first started now a long time ago, we'd go, oh, go to age 90. And then it went, oh, plan to age 95. And now we plan to age 100. And so it won't surprise me if we end up planning further. I'll say the caveat on that is when I'm doing to age 100, just by the nature of my clients, they're not running out of their dollars at age 100. So they were not in a scenario where if they get to 102, we're hooped. Usually the home value is still there, and given where we live and who our clients are, that's millions of dollars of value at that point that hasn't been sold. TFSAs are usually continuing to be maxed out for that long term. So I'm less concerned about, does the financial structure support the lifestyle and care of the individual past age 100? It's just giving us enough guidance to say, here's the projected values of what's going to be there. A lot of them are growing in wealth over time because they're penny pinchers. They were like my Nana. They cut the tomato coupons and they go to this store to get the dollars. And even though they have the dollars, they're still in that frame of mind. And so they're going to continue to save because of just who they are as individuals. They're not going to outspend it.
Yeah, I have a lot of clients in their 90s that have a tough time spending their CPP check.
Yep.
The thing they don't tell you in the manual is keeping a 90-year-old plus frame going doesn't cost a lot in groceries. Like, you're not eating a ton, right? But it is interesting to see how it's changed over our careers. When I first got my certified financial planning designation, pre-Great Financial Crisis, we were planning to 85, and it is quickly expanded to age 100. It's amazing how that's happened as the wealth and medical advancements continue. It's really cool to watch. It is terrifying for, I think, a segment of humanity that's going, I got to spend how many years in retirement? How's this going to work? Like, where's the money coming from?
That's really adjusted. Yeah, that's really adjusted things, because if you think I retire at 65, 15 years of retirement and move on from there, 20 years of retirement, now you could have 40 years of retirement.
Yep.
So that's adjusting what we need to save for, because now you're not working for 40 years. You need to have the capital to cover that. And then people are also having better retirements. And by that, I mean, it used to be at 75, things kind of slowed down. My grandma at 93 just stopped golfing last year. So your enjoyment of life is longer and better, and expenses obviously have to be considered. Thankfully, medical illnesses that used to keep people from surviving in their 70s they have the critical illness, they come back and now they still have 15 years or so left. So it's all of that is interplayed and needs to be considered.
It's a good point. One of the biggest conversations I have with people approaching retirement is actually around, what are you going to do? Because if you haven't thought about what your purpose is, eventually you're going to start declining at a much faster pace. And we have all sorts of clients in their 80s where I have to constantly look up their birth date because they appear and operate as somebody like in their early 60s. They're busy. They've got volunteer activities. Some of them are still working at different jobs part-time. They're taking care of grandkids. They're going traveling. They got all sorts of hobbies. And then the other group that is just going, I don't know, I'll figure it out. They get into retirement and a few years pass by and I see them and I'm like, so what are you doing? And they're like, I don't know. I haven't figured it out yet. And you can see the decline happening in real time where they don't have something that drives them. And that tends to be the bigger conversation now. It's not like, do you have enough money to make it to 100? It's, what are you going to do with your life so that there's life between age 60 and age 100? Because a lot of folks have not thought about that. It's really amazing.
There's some data that came out. I forward it to my parents whenever I see it and I see it in various formats. So I just forward whenever I come across it. And it talks about grandparents and helping with grandchildren. So I jokingly go like, yeah, take them, help me out. But now I rephrase it and go like, I only want you to live longer and better, because it's all about grandparents. The more they engage with their grandchildren are living longer. Their propensity for dementia and Alzheimer's is pushed later. And it's because young kids, if nothing, they will keep you active and on your feet because you're not just sitting there hanging out with them. You're out and doing things. And the fact that you're engaging, you're having to think, where are they? What are they doing? What's the snack? What's the activity? Who climbed up what tree? All that kind of fun stuff. It's exercise for the mind. So it's exactly to your point. The more that's actually going on, one, they're going to have better retirements and they're going to have longer retirements because of it.
Yeah, I love those data points. All the different things you can do to keep your mind active. One that I used to talk about a lot, but you can't really get anymore, was people that drove a standard transmission vehicle tend to live 18 months longer than people that drove an automatic, because it's just that daily, you had to figure out the coordination between your clutch foot and your hand doing the shifting. But now you can't really find a lot of standard transmission cars. So I don't know how that data is going to update.
The opposite though. Are we going to have like the Tesla self-driving cars? Is that going to shorten compared to
What a goofy unintended consequence, right?
Yeah.
Anyhow, I really appreciate you having this conversation with me, Jacqueline. I love sending our clients to you. I always feel so confident that their financial plan will be seatbelted effectively by you. And it really does make the foundation of a good financial plan to make sure that the risks are taken care of up front. And then we can make sure that a client is never going to be poor or in a really bad situation. And then we can worry about making sure we're preserving capital and growing their wealth. So thank you so much for being a part of the team and taking the time out of your busy week to have this conversation with me.
Thank you. Thanks for having me. And honestly, what's I really appreciate is there are a lot of advisors who they only think about insurance when it comes to that wealth planning. And I think it's such an underserviced type of client who, thankfully, you don't miss it, is to say, yeah, it's not maybe the big thing or like the big consideration on your end, but it's a big important for the client. And so you're addressing those, which I think is really critical.
Yeah, awesome. Well, thank you so much again.
Thanks. Have a good one.
Okay, thank you so much for listening or watching today, and please find us at helmfinancial.ca for ways to connect with my team. Information, of course, in this podcast is from sources believed to be reliable. However, we cannot represent that it is accurate or complete. It is provided as a general source of information and should not be considered personal investment advice or a solicitation to buy or sell securities. Raymond James advisors are not tax advisors, and we recommend that clients seek independent advice from a professional advisor on tax-related matters. The views are those of the author, John Helm, and not necessarily those of Raymond James Limited. Any investor should consult with their investment advisor to ensure that it is suitable for the investor's circumstances and risk tolerance before making any investment decision. Securities-related products and services are offered through Raymond James Limited, a member of Canadian Investor Protection Fund, and insurance products and services are offered through Raymond James Financial Planning Limited, which is not a member of the Canadian Investor Protection Fund. Raymond James USA Limited advisors may only conduct business with residents of the states and or jurisdictions in which they are properly registered, and Raymond James USA Limited is a member of FINRA SIPC. Thank you very much again for your watching, and have a wonderful day.